The Fed on hold sends stocks up across the board. Managing partner at Tangent Capital Partners, Fox Business contributor Bob Rice is with me now. So, Bob, for all those who think, oh, really the Fed's decisions are just important for the banking world, for the business world, it's actually not true. It affects everyone. Right?
Of course, it totally affects everyone. You know, when the Fed makes a decision to raise rates, it sets off a series of dominoes. That changes the prime rate. The prime rate changes your mortgage rate in some cases, or your credit card rate, or your student loan rate, or your car loan rate.
So if people have any form of debt, this is important.
Absolutely. But what's even more important than that, because the Fed is going to do this very, very slowly, it's not the amount that when they eventually raise, it's not the amount by which they raise, it's the fact that they raise. It's a huge U-turn in a 7-8 year path for lower and lower rates have gotten to zero. So that the mere fact when they turn, that they're turning, that's going to matter to people a lot.
Because you don't know how many people say to me, oh, should I go and lock in a fixed rate mortgage now before the Fed moves in December?
When they move, they're going to move very, very incrementally. But that's not the point. The point that makes it really important for consumers, and a lot of people may well be saying, why do they cover this so much on TV if it's not that important and the rate's going to be small and everybody goes crazy? It's because the asset prices that we have, the stock market, and your home prices are tied very directly to the fact that the Fed has kept rates so low. Remember what happened in 2007, 2008, right? Your stock portfolio went to zero, got creamed. Yep. Your house price got creamed. Why are they back? Well, they're back because the Feds have kept rates so low. So what happens if they now turn around and start to raise them again? Maybe those values are going to start to decline.
So then for the average investor, what is the takeaway? Because we heard Janet yell those 4 words, at its next meeting, the committee will evaluate ... But at its next meeting, that stood out to a lot of people. So it's coming.
She wants to make you think it's coming, which is why she keeps saying it. She's been saying that for a long time. There's nothing new in that message. But what you do have to prepare for, and you don't want to have to do this overnight, what you have to prepare for really is a new world. Rates cannot really realistically keep going. They're almost at zero, right? They have to start going up. And so that means a lot for your financial assets, specifically, number one, any bond funds that you happen to be in, whether it's a 401k plan that you're invested in or you own them directly or whatever. Most people own bonds. Those bonds are going to lose value as rates rise. And remember that 2 years ago, 80% of bond funds lost money. Those safe bond funds lost money. 80%. Yep. That's what you really have to watch out for.
All right. So evaluate your bond holdings. Bob Rice, thank you. Always good practical advice. Managing partner at Tangent Capital Partners.